Welcome back to Bloomberg Quint. Well, Infosys is out and now we have earnings from TCS, where again the numbers seem to be, well, fairly in line. Perhaps when it comes to the revenues front, slightly higher than expectations, and it's a little bit of a miss when it comes to the margins front. But on the whole, if you look at the holistic picture, mostly in line with street expectations. You know, we do have some experts to talk to you about that. But before that, let me just quickly go through the headline numbers. So revenues in rupee terms rising 1.8% to 38,010 crores. EBIT margin standing at 25.1% versus 25.6%. So about a 50 basis points cut when it comes to TCS, and of course slightly lower than our own expectations of 21.5%. And when it comes to net profit, an uptick of 0.3%, and this is where we have seen a little bit of a surprise because we were expecting a decline of around 1.5%. So on that note, let me get in an expert here. We have Sanjeev Asin, Executive Vice President Markets at IIFL, who's joining us on the phone line. Sanjeev, thanks for taking the time out. Your initial take on TCS, largely in line?
Yeah, largely in line, but again, sacrifice of margins for order flow and going forward, what's the timeline? Because the rupee, which was a tailwind, has now become a headwind, and some of the wage increments because of the hiring in the US. These are two of the negatives. But otherwise, I think these numbers were very much in line to what was the expectation.
Okay, so Sanjeev, this is the thing. I mean, you know, we were all expecting a little bit of weakness in margins. You know, I'm not going to bring in Infosys here because that has its own challenges. But even for TCS, considering we are looking at this increase in talent expenses that the entire industry has been talking about, the question really is that do you think that could hamper TCS's projection of 26 to 28%? The company has been talking about this for maybe 2 years now, and they haven't managed to get into this particular range. But what is your outlook on margins going forward? You've already addressed, you know, the currency aspect about it, but what about the rest of the operational features?
Correct, and you are in an atmosphere where globally things are looking extremely weak rather than, I'm not very pessimistic, but Europe is the elephant in the room. They have a huge outflow there. How long can North America continue to be the chugger? And what is the other effects of artificial intelligence, cloud computing, the other verticals? Digitalization. Digital has been their biggest positive. But going forward, will they be able to maintain this run rate? Seems very much, I would be a little doubtful on that. And like I said, the rupee, the wage elements, all these are going to play out on the negative side. If anything, I would expect margins to be slightly more weaker going forward rather than anything on the upside.
Sanjeev, if you can just hold on to that thought, I'm just going to come back. We also have Harit Shah, Senior IT Analyst at Reliance Securities, who's joining us on the phone line. Harit, hi, thanks for joining in. Your initial take in line with your expectations for TCS?
Hello.
Yes, Harit. My question was your initial take on TCS earnings.
Yeah, I think overall the performance was in line with expectations. Revenue was a little bit better than expected actually. We were expecting about 2.1 or somewhere in that range. So they achieved about 2.4% in constant currency. Margin was slightly below what we were expecting, about 25.4 or 25.5 is what we were expecting, then 25.1. Okay, but I think overall, nothing too majorly negative to complain about. I've not got a chance to actually look at the granular details in terms of vertical growth and that sort of thing as yet.
Okay, all right. We also have Trip Chaudhary, Managing Director at Equity Research at Global Equities, joining us on the phone line. Trip, let's start with TCS first. What are you making of the numbers? How are they looking to you?
I think they were just as on plan. I think this is good news because what it shows is that TCS is able to sustain its customer base. They're coming with new services in the new technologies, cloud, machine learning, deep machine learning. And I think the whole IT services industry as a sector as a whole is going to see a secular growth moving forward. And the reason for that is the global economy is slowing down. So when the economy is slowing down, the customer is looking for the best talent at the cheapest price. And that is what fuels the Indian IT services, and TCS will be a beneficiary of that. The difference is TCS, Infosys, and the larger Indian companies have repositioned themselves. They have reskilled themselves for new technologies, the services demand of which are strong.
Okay, Trip, and how would you compare? I know that you've spoken about TCS, in the same breath as the entire industry. So how would you compare those with Infosys? I'm talking about the margins specifically for Infosys because the contraction here is larger than what we were working with. What do you make of the margins specifically, and also the guidance that the company has given out for margins?
See, I don't think that should be the focus at all, because remember, when you are winning new customers for new services with a completely new set of value propositions, you have to go for a land grab. You win these large deals, and then over a period of time, the margin improves. I think right now it is very important for all these Indian IT services companies to go for a land grab. Make sure they are winning deals, because it is make versus buy. Do you want the customer to build their own team and everything, or would they be better off letting Infosys, TCS, and others do the work? And right now, I think it is very important for almost every long-term investor to focus on deal wins. Margins will come maybe 12 months from now, but the foundation for margin expansion happens when you're able to get the customer's attention. That is exactly what Infosys is doing. That is exactly what TCS is doing. That is exactly why Infosys, TCS, and other Indian IT services companies will provide investors with a better return. But you need to have a longer-term investing horizon.
Okay. Harit, if I can take a question up with you, what are you keeping an eye on when it comes to management commentary now?
Yeah, I think the outlook in terms of obviously, what would be their aspirational margin band. So Infosys has clearly reduced their band by 100 basis points each. I don't think there seems to be any issue on the revenue front. Clearly, they are being, they should be able to drive at least double-digit growth in FY20 without any major problems. They've been able to, effortlessly maintain their growth rate and, deal wins also, plus, maintain margins better than most of the peers. So I think in this environment where you're having a lot of wage cost inflation because of talent shortage on the digital side, plus a potential rupee appreciation scenario, it is very critical to get a better sense of the margins and how what steps are these IT firms going to take to manage that.
Okay, Harit, we leave it at that. Thanks for joining us and taking us through your views. But Trip, I'm going to come back to you. Actually, the same question to you as well. What would you like to hear from the management?
I think it will be very important to focus. The management focuses on three things. Number one, they need to make sure that they are hiring new talent. Number two, they are able to reskill the existing talent they have, because it is all people's focus. People first, rest all comes second. Number third, they need to continue to invest in the training and in building new capabilities. I think this year should be a year of investment, and investors should not be hung up on margins, because that's a very short-sighted way of looking at the company. This is a time for in almost every Indian IT services company, including TCS, Infosys, to invest in their people, give them raises, make sure they are motivated, make sure they are getting whatever deals they can get, because today they get the land grab, tomorrow they will have the margin expansion, but the first step has to happen. And the margin fixation on margin guidance is very short-sighted. It should be the talent and the capability expansion in fiscal year 2020 or calendar year 2019. That should be the focus.
Right, the capability expansion part is what I wanted to ask you further about, Trip, because there has been, and a lot of people are talking about competition in these markets in which TCS and Infosys are also operating. How do their capabilities stand currently in comparison to the competition when you already have, not as many clients, or there is a little bit of a fight against clients, even though loyalty does play a part here? Can you tell me a little more about how capabilities stand for TCS and Infosys currently?
I think, the way you frame the competition, the context has to change. It is not the competition between, say, Infosys, TCS, or Tech Mahindra, or Capgemini, or Accenture. The competition is in-house development that the customer is doing versus what Infosys and Indian or TCS or Indian IT services can provide. It is, you want to do everything yourself, or would you like to make sure you partner with somebody who brings the best specific skills at the lowest possible price, while giving you the flexibility on your operating expenses. So that's the focus. Would you let the company do everything themselves and have a fixed cost, or would they like to have a flexible workforce with flexible cost but very high precision skill sets? So they have to do three things. Number one, educate what Infosys or TCS or any IT service can bring to the table. And that comes with showing that the new capabilities they have achieved. And I know, based on what I'm seeing here in Silicon Valley, is almost every Indian IT services companies are expanding the skill sets by certifying their engineers, their workforce on the leading technologies like Google Cloud, Amazon AWS, Oracle Cloud, you name it. Then certifying them on various deep machine learning frameworks, TensorFlow, just to name a few. So it is not competition between one IT services company versus other. It is in-house versus flexible workforce. So that's where the focus is. And I think when you have a shrinking economy or slowing economy, which is happening right now in the world, the customer is more open to a situation where they can have the flexibility of headcount while having a precision of skill sets. So I think the market is providing a tailwind to the Indian IT services companies. And I think it is time for Indian IT services companies to go and grab the deals at whatever price it is. Because you are not a player if you don't show up. You are 99% there if you show up at the customer's door. That's exactly what Infosys, TCS, and everybody has to do. Because the benefits comes a year out from now. I don't think neither Infosys, TCS, or investors should be hung up on the margin. There are two types of margin: bad margin and good margin pressure. This margin, 21 to 23%, whatever Infosys has guided, is very good margin guidance, because it is margin based on land grab, acquiring the customers, entering into new capability space. The returns on this strategy is very good for the long-term investors. If somebody is just investing for 1 day, 2 day, 1 quarter, Infosys, TCS, and other companies are not for them. But if they're investing for plus 1, 2, 3 years out, their returns will be very good.
Right. Fair enough, Trip. We'll leave it at that. Thank you so much for joining us and giving us your take on what the way forward should be for some of these Indian information technology companies. But we also have Bloomberg Queen's Sanjeev Mangat out there at the TCS headquarters to get us more details. Sanjeev, what more do you have for us when it comes to TCS?
Okay, I think you must be having most of the numbers by now, but let me take you through some of the dollar numbers which I've got. For revenue is at $5.39 billion. On a year-on-year basis, it's up 8.5%, and in constant currency terms, it's up 12.7%. Operating margins have dipped marginally on a year-to-year basis, and as per poll as well, because we were looking at somewhere around 25.5% of operating margins or EBIT margins there. It has come at 25.1% at the end of fourth quarter. Net income is at $1.15 billion, and the company has now in FY19 crossed $20 billion in revenue as per the total numbers there. So it's pretty much in line with what Street has been expecting. Margins have been slightly sluggish, and we will get to know some of the headwinds that the company may be facing in terms of margins going forward as well when the press conference happens.
Fair enough, Sajid. We'll wait for the press conference. Thanks so much for joining us and getting us those details, Sue. So, well, that's as far as the, your quarter four for TCS goes, and it looks like a fairly stable quarter for TCS too. Nothing out of the ordinary, even though there just might be a small disappointment when it comes to margins. But as Trip Chaudhary has told us, these margin pressures are not as important as these companies are going ahead and concentrating on growth and grabbing as many clients as possible going forward. But on that note, we take a break, but we will be back soon when we have the management of Tata Consultancy Services join us. Until then, well, we'll keep getting you more details, and until then, it's goodbye.